A good evening to everyone. I'm Ikai from FXM1. Welcome to this evening webinar, Key Investing Opportunities in 2026 that you should not miss. So 2026 started strongly with gold prices smashing through the roof and the US and Asian markets performing strongly as of today. Closer to home, Singapore has done very well too. With the STI index is trading in the 4,900 range. So what should we focus on then for 2026? So this evening, I'm privileged to have Tan Jin, Portfolio Manager, and Shamin Tan, Research Analyst from the iFAST Research Team with me. So Jin will share on the game plan for FSM Management of Portfolios, or MAPS in short, for the year of 2026. Charmaine will then share on S-REITs, an asset class that has been beaten heavily over the recent years, yet it still remains a favorite darling among local investors. So if you have any questions along the way, feel free to put them into the Q&A box below, and the speaker will get to them at the end of their respective presentations. So due to the time constraint, I have to apologize first if you are unable to answer all the questions, and I seek your understanding in this. So without further ado, let me pass over to Jin to start the webinar going. Jin, please.
Okay, thank you, Yikai. So good evening, everyone. Just let me share my screen first. Okay, great. Welcome to tonight's webinar. So yeah, my name is Jin and I'm part of the research team here at iFAST. So I'll be kicking things off with an update on our MAPS portfolios. So over a year has passed since we introduced our new investment approach, and today I'm really excited to share with all of you how has it performed throughout 2025 and what it means for your portfolio going forward. Now, before I get into the updates proper, let me just start with a quick introduction to our MAPS portfolios for those of you who may be new. So MAPS is our online managed portfolio solution that is designed to make investing simple and convenient. So rather than worrying about what to buy, when to rebalance, or how markets are moving, MAPS handles everything for you. So from building your portfolio to selecting the right investments to monitoring markets and rebalancing when needed, we will take care of all the details so that you can invest with confidence and peace of mind. So simply put, MAPS gives you a hands-free way for you to grow your wealth. And to make this possible, we have a dedicated team of over 10 portfolio managers and analysts who are based in Singapore, who closely monitor markets and they contribute their best ideas into the portfolio. So we are also supported by a wider regional research network spanning across countries like Malaysia, Hong Kong, and China, providing additional insights whenever needed. So MAPS is not a new offering. It is a proven solution that we have been running for close to 9 years already, since late 2016, through different market cycles. So here are a few ways MAPS can add value to your investment journey. So first of all is professional management. So as a managed portfolio solution, MAPS gives you discretionary management, meaning our experienced team will handle everything from the day-to-day investment decisions for you. So from portfolio construction to product selection, we'll take care of everything. And although this is a discretionary portfolio, rest assured that every action that we take, it is aligned with the investment objectives and also the risk profile for each portfolio. So the second benefit is diversification. So if you're familiar with our portfolios, they are not only diversified across markets and sectors, but they are also diversified across products as well. So we combine unit trusts and ETFs inside our portfolio to strike the right balance between active and passive strategies. So on one hand, unit trusts, they can help to uncover hidden opportunities through active management, while ETFs, they provide broad-based exposure at a very low cost. So we put these two products together, it allows our investors to enjoy the best of both worlds. So for product selection, we rely heavily on our recommended list, which is a curated collection of top-tier unit trusts and ETFs that have been carefully selected by our research team. So the third is accessibility. So you can start with as little as 500 Sing dollars for a lump sum investment, and monthly RSP contributions, they start at just 100 Sing dollars per month. So MAPS also offers both income and growth portfolios, each with 5 different risk profiles ranging from conservative to aggressive. So there's definitely something for everyone. And on top of that, I think our fees are also pretty competitive, starting from as low as 0.0875% per quarter. So overall, Again, MAPS is basically an investment solution that provides you with a hands-free approach for you to grow your wealth and is ideal for investors seeking convenience without the stress of monitoring markets daily. So all you need to do is to choose which profile you are comfortable with, and we will do everything else for you. It is that simple. Now, since inception, I think MAPS has followed the same guiding principle, which is to maximize risk-adjusted returns over the long term through value investing. So what does this mean in practice? So first of all is proper diversification. So to us, having successful investing is not about building, it's all about building a resilient portfolio that can weather different market cycles, which is why we spread our investments across various asset classes, geographies, and even product types so that no single event or market move will define your results. So second is a focus on fundamentals and valuations. So at FSM1, we are all long-term value investors. So that means we don't chase short-term trends or try to predict every market swing. Instead, we concentrate on high-quality assets with strong fundamentals that can be purchased at sensible valuations. So by focusing our attention on fundamentals such as earnings growth, valuation, structural factors, what we aim to deliver is sustainable returns over time through investments that are compelling today and are resilient for the long term. And last but not least, we always invest with a long-term view. Now, with that out of the way, let me move into the updates proper, starting with a recap of our portfolio performance in 2025. So I'm pleased to share that 2025 was another strong year for our MAPS portfolios. So you can see on the chart over here, our growth portfolios delivered returns ranging between 6% and 16.9%, building on the momentum from 2024, where returns range between 5.7 and 12.9%. So returns for our income portfolio are also in the similar range, ranging from 6.4 to 16.4% versus 2024's return of between 5.1 and 11.9%. So as you can see here, the more aggressive portfolios outperform their conservative counterparts, driven by equity strong performance versus fixed income in 2025, especially in the EM space. So I'll dive deeper into the factors behind our portfolio performance later on. So even better, this chart over here shows you our performance since inception, and you can see that our balanced, moderately aggressive, and the aggressive portfolios have all reached new all-time highs. And for those of you who are in our moderately conservative and conservative portfolios, don't worry, you're not too far behind. So overall, the portfolio performance over the past 2 years, I think it highlights the effectiveness of our revised asset allocation methodology, and it also reinforces the value of staying disciplined, diversified, and most importantly, focused on long-term investing, even through different market cycles. So going forward, we will strive to deliver even better results for our investors. Now, let's take a closer look at how major markets have performed in 2025, and I'll link that to the impact on our portfolios. So looking at this chart over here, you can see that major regions, developed markets delivered a more modest return of 14.5%. And within that, the US is a notable laggard, rising only 10.9% in Sing dollar terms, making it one of the weaker equity markets last year. So elevated valuations, rising policy uncertainty weighed on performance, and on top of that, a weaker US dollar further eroded returns for Sing dollar-based investors. So in contrast, if you look at European markets have had a very strong 2025, with the Stock 600 index rising by almost 29%. So Europe staged a comeback as growth and business confidence improved. Valuations remained relatively attractive compared to the US, and also investors rotating into cheaper, dividend-paying, and more cyclical European companies as the economic outlook for the continent brightened. So besides Europe, if you look at Japan, Japan also did fairly well, notching a gain of around 22% across the year. But the real story here, though, is in emerging markets. So 2025 was a very strong year for emerging market equities, which saw returns of more than 26% on aggregate. So you can see that within that universe, markets like South Korea and Taiwan, they were the standout performers, helped by a rebound in semiconductor-related stocks and also improving demand across global technology supply chains. So on the sectoral side, semiconductors, they continued to be a major winner as the AI team kept delivering this year. So even though semiconductors, I think they had quite a slow start to the year, they managed to finish up around 40%, which is quite remarkable considering how the broader US market has performed. Moving on to the fixed income space. So 2025 was a year that favored emerging markets also, with both emerging market debt and high yield bonds delivering standout returns of around 12% in local currency terms. So these asset classes, they benefited from a combination of factors such as easing monetary policy in several EM economies, improving credit fundamentals, and investors search for yield in a still elevated rate environment. So this carry advantage of emerging markets and also high yield bonds, they prove attractive as default rates remain contained. So Asia high yield also performed well, returning 9.6%, and this is largely supported by a stabilization in China's property sector and improves risk sentiment towards the region. Asian IG segment delivered a respectable 8.1% return, benefiting from the region's solid credit quality and attractive spreads relative to developed markets. So in contrast, global investment grade bonds posted a more modest return of just 8.2% as developed market bonds were constrained by inflation concerns and central banks maintaining higher for longer rate policies. But the broader global bond market saw relief from peak yields. Returns were lower, were tempered by duration risk and the relatively compressed spreads in developed markets. So overall, if I were to sum up the performance for fixed income markets, I think in 2025, fixed income markets, they were largely driven by falling yields and tightening credit spreads. Now, moving on, let's take a look at some of the areas that we have done well in 2025. So if you've been invested with us for a long time, you will know that digital economy is one of the core allocations inside our portfolios. And we strengthened this view by increasing our exposure from neutral to overweight in October, even as we underweighted the broader US market, which I will get to later. So for the digital economy, we remain highly confident in the long-term growth potential for tech-driven businesses, which has continued to benefit from structural trends such as rising AI adoption and ongoing digitalization of the global economy. So this selective approach has allowed us to capture the upside in high growth sectors while effectively managing the overall market risk. And within the digital economy sleeve, the VanEck Semiconductor ETF delivered returns of more than 40%, which helped to lift the overall performance for the segment, even though our other two funds inside, which are the Invesco Nasdaq Internet ETF, as well as the Fidelity Global Tech Fund, they underperformed. So on aggregate, this segment delivered returns of more than 23%. So the second thing that we did well was to diversify. So specifically, reducing exposure to the US and increasing allocations to other regional markets, including Europe and emerging markets. So we recognize the headwinds that the US economy is facing earlier in the year, and we actually moved to an underweight position and redeployed capital into these regions, which proved to be beneficial as our fund selections outperformed. Notably, the Dimensional European Value Fund delivered a strong return of more than 42%, which made it the best performing fund inside our portfolio for 2025. For emerging markets, our fund picked coincidentally Dimensional as well. It also did fairly well with a return of more than 24%. So the third thing that we did well was to maintain our overweight exposure to Japanese equities. So even though we trimmed our Japanese equity exposure back in September to lock in some profits, we retained a 5% overweight for the first 9 months of the year, which really supported portfolio performance as Japanese equities have done really well. And our fund pick also, the one from Eastspring Investments, have delivered strong returns of more than 21% across the year. So the last thing would be to extend the portfolio's duration by allocating more to global bonds from shorter duration bonds. So this also contributed to better performance for our portfolios. So this strategy benefited from falling yields and the highest starting yield of the fixed income markets, with the PIMCO Income Fund delivering strong returns of around 10%. So this slide over here shows you a summary of all the changes that we have made in 2025, which I have explained earlier in detail already. So looking ahead, I just want to quickly highlight a few key points from our 2026 investment outlook and how they actually apply to our portfolios. So the first point that I want to highlight is that we remain extremely constructive on the long-term prospects of the digital economy. Sure, if you look at share prices, valuations, they have gone up across the sector. But what I want to share is that they are well supported by strong earnings. And we do expect earnings growth in the double digits each year over the next 3 years, driven by factors like rising AI adoption and greater technology spending. The companies that operate in this space are also generally of very high quality with strong balance sheets, solid growth potential, and supported by structural factors. And all these things make these companies very appealing. And if you look within the digital economy segment, I think semiconductors will probably be one of the most exciting areas. So similar to the broader digital economy sector, I think earnings in this space, they are expected to grow by almost 30% annually, thanks to huge AI spending from big tech firms. So one thing about the semiconductor industry which we like is also because the industry it is highly concentrated with extremely high barriers to entry. This also gives the big players a strong advantage that allows them to capture the most of the rewards. Now, let me now turn to our outlook for Japanese equities. So Japan is currently experiencing a reflationary backdrop that is creating a favorable environment for equities. So in Japan, we are seeing healthy wage growth and rising consumer spending, which supports domestic demand and corporate revenues. On top of that, corporate reforms continue to fuel the investment appeal of Japanese equities. The ongoing push for better governance, better capital allocation, and enhanced shareholder returns, including higher dividends and share buybacks, it is making Japanese equities more attractive to both domestic as well as international investors. And as of December of last year, the share of Nikkei 225 companies with a PB ratio of more than 1 has actually risen from about 45% in 2022 to more than 75% already. And on the earnings front, we also expect resilience driven primarily by growth in the tech sector. So Japan is also making a significant strategic investment in its tech sector. The government has committed roughly 1 trillion yen annually starting in FY 2026 for its AI and semiconductor development, with particular focus on advanced 2 nanometer chips through the Rapidus Corporation. So Japan is also building out its domestic cloud ecosystem, positioning itself as a critical player within the global technology supply chain. And I think for Japan companies that are aligned with these semiconductor AI ambitions, they should see strong fundamental support. So overall, we still see a constructive setup for Japanese equities that are built on 3 pillars. The first is a reflationary backdrop supported by real wage growth. Second, ongoing structural reforms. And the third, tech-driven earnings backed by substantial government investment. Overall, 2026 looks to be another strong year for Japanese equities. And yeah, one more point to mention that a rebound in the yen may also be on the table, which should add to the total returns for Singaporean-based investors. So before I wrap up, let me give you a quick snapshot of our current asset allocation so that you have a clear view of how your portfolios are positioned. So first of all, our inter-asset allocation, it remains neutral for now. So that being said, we are actively monitoring market conditions for opportunities to increase equity exposure. And the reason is simple. That's because equities, they are the primary driver of long-term returns. And should the recent market sell-off continue, I think we will look to selectively add more equity exposure as well. And within equities, we are underweight the broader US market, while we are overweight the digital economy and Japan for the reasons I just mentioned a couple slides back. And across the rest of the markets, including Asia ex-Japan and emerging markets, we maintain a neutral stance. So over here, you can see how our investment outlook actually translates into the way our portfolios are positioned. Moving on to our fixed income intra-asset allocation. No changes here. We are still overweight global bonds and shorter duration bonds. We are neutral Asian investment grade as well as EM bonds, while we are underweight high yield and Asian high yield. So overall, investment grade bonds, they are still preferred over high yield as they offer more dependable income with relatively lower risk. I think valuations in the high yield segment, they also appear more stretched, which makes the risk reward ratio less compelling at this stage. So as a result, investment grade bonds, they are still our preferred option for from a risk reward perspective. So overall, we don't expect to make any significant changes for now, as we believe that our current positioning remains appropriate. This should be viewed positively. So ideally, I think we also try to minimize unnecessary adjustments so that we can stay invested and avoid being out of the market for extended periods. Okay, so I think that should conclude my updates for today. If you have any questions, please feel free to use the Q&A function, and I'll be happy to answer them at the end of the session. So one last thing I'd like to say is that investing can be challenging, especially when markets move quickly and you don't have time to monitor them. So this is where a managed portfolio solution like MAPS can be valuable, where we can provide professional oversight and also a disciplined approach to help you keep your investments on track. So let MAPS handle the work so you can enjoy the better things in life. Thank you, and I will hand the time over to the next speaker.
Thank you, Tachin. Okay, give me a while. Okay, hi everyone. So today I'll be sharing the outlook for Singapore Real Estate Investment Trust, or S-REITs in short, heading into 2026. And as we know, SORA has come down meaningfully over the past year. And while this may actually appear less favorable for the banks, it is actually supportive for S-REITs. And previously, the sector had been navigating a very challenging period of elevated interest rates. But with financing costs now easing, we believe S-REITs are actually entering a more constructive phase, one that is marked by selective recovery and emerging growth opportunities. Without further ado, let's start with our core investment thesis. So on this slide, we see four key pillars underpinning returns this year. So firstly, a macro pivot away from high interest rate, and secondly, the return of fundamental resilience, and thirdly, a geographical advantage we call the Singapore Shield, and last but not least, valuation support. And also across the S-REIT subsector, we remain overweight industrials, prime CBD commercial, and suburban retail, where the combination of strong fundamentals and structural tailwinds is the most evident. And turning over to our first pillar, the macro backdrop, the era of rising financing costs is behind us. Easing interest rates and the lower SORA are now filtering through into REITs books. And this is actually reflected in improving interest coverage ratio, ICR, and lower borrowing costs, which actually eases pressure on cash flows for these S-REITs. And it's important to note that because many of these S-REITs actually stagger their debt maturities and hedge a portion of borrowings, the impact of rate cuts tends to be more gradual. And with that being said, with a significant share of debt maturing between now and 2027, refinancing at a lower marginal cost will actually increasingly support earnings and distribution for these S-REITs as well. And in simpler terms, macro relief is already showing in balance sheet. Take CapitaLand Integrated Commercial Trust, CICT, and Fraser Centrepoint Trust, FCT, for example. Both have actually seen interest coverage ratio improve to around 3.5 times, largely due to a decline in the average cost of debt. So this actually means that how much of their profit can actually cover their interest expense. So it would mean that if the ratio is higher, it will be a better number. And just for reference, the MAS actually regulate this number to actually be of a minimum amount of 1.5 times. So between 3.5 times and 1.5 times, there's sufficient headroom for these S-REITs. And this would actually demonstrate that strong balance sheet are actually benefiting first, reinforcing the need for selectivity. And this brings us to our second pillar. With financing costs easing, REITs managers are actually moving back onto the front foot. So we are seeing a revival of capital recycling, with managers pursuing accretive acquisitions while divesting non-core assets. And this renewed momentum actually reflects improving investor confidence and lower capital costs. This actually enable capitalized REITs to execute a growth strategy that were actually previously delayed. And with REITs with a strong sponsor and disciplined balance sheet, they are actually particularly well positioned to capitalize on this environment. And this includes REITs managed by CapitaLand, Mapletree, and Keppel, which benefit from deep sponsor pipelines and access to private portfolios. And for example, CapitaLand Ascendas REIT has actually demonstrated disciplined capital recycling through the divestment of 5 assets across Singapore, Australia, and the US, including the sale of Parkside in the US at a 45% premium to valuation, while recycling capital into higher quality growth assets, such as a fully leased acquisition at 9 Tai Seng Drive and 5 Science Park Drive, as well as a SGD 883 million redevelopment of 1 Science Park Drive. And according to CapitaLand Ascendas REIT, if both acquisitions were actually acquired at the start of 2024, they will have contributed DPU accretive of 1.24% and 0.14% respectively. And similarly, for Mapletree Industrial Trust, they have continued to reshape its portfolio by divesting mature Singapore assets while redeploying capital into higher specification properties, including a freehold asset in Tokyo and the completion of its Osaka data center, reinforcing its pivot towards more resilient, technology-oriented assets. And higher contributions from these 2 assets actually mitigated the overall decline in net property income in the quarter last year. And meanwhile, Keppel DC REIT actually achieved 42.2% year-on-year growth in net property income through strategic data center acquisition, which is a clear signal that growth is actually back on the agenda. And next, the third pillar is the Singapore Shield. So success in this growth strategy is actually highly dependent on geography. So in a volatile global environment, domestic exposure actually matters. In third quarter results last year, S-REITs with high Singapore exposure like CICT and AIMS APAC REIT, with more than 3/4 of their revenue coming from assets located in Singapore, actually reported stronger rental reversion. And in contrast, REITs with lower domestic exposure such as Mapletree Peninsula Commercial Trust were actually weighed down by weaker overseas assets. And in short, the takeaway is that Singapore-focused assets actually provide stability and resilience, especially in uncertain times. And with global markets showing heightened volatility, like what we see last year, we are actually seeing increase in capital inflows into Singapore assets. And investors are actually recognizing and paying what they call the Singapore premium for the stable outlook and attractive dividend yields. And let's now zoom into individual sectors, starting with industrials and logistics, which is our highest conviction segment. So Singapore's industrial and logistic market actually continue to display exceptional strength, supported by sustained rental growth, tightening occupancy and firm demand from manufacturers, third-party logistics operators, and technology tenants. So the JTC or Industrial Rental Index actually recorded its 20th consecutive quarter of increase, rising 0.5% quarter-on-quarter in third quarter last year. And since the market bottom in third quarter 2020, rents have actually expanded at a CAGR of 4.6%, underscoring how the sector has remained one of the most consistently expanding corners of the real estate market, even with global volatility being so present last year. And within the broader industrial landscape, logistic assets are actually leading the outperformance. So warehouse rents actually accelerated to 0.9% quarter-on-quarter in third quarter last year, and supported by strongest net absorption since second quarter 2023, and a moderation in new completion. And occupancy actually climbed 0.8% to 89.6%, further supported by robust take-up from major third-party logistic firms. And prime logistic assets also saw meaningful tightening, with occupancy rising from 92.1% to 93.6% within a quarter as demand for high-spec ramp up with modern warehouse space actually intensified. And recent additions, such as CapitaLand Ascendas REIT new 6-story redevelopment at 5 Tong Guan Road East, underline how landlords continue to invest in modernizing supply, a trend that supports both rental resilience and long-term competitiveness. And in third quarter last year, S-REIT with industrial exposure such as CapitaLand Ascendas REIT and Mapletree Industrial Trust have also shown healthy rental reversions. And looking ahead, the outlook for industrial and logistic assets actually remains firmly positive. Global AI investments is driving sustained requirements to semiconductor-related manufacturing and high specifications facilities, while the logistics sector continue to benefit from the strong third-party logistic expansion and supply constraints in the prime warehouse segment in Singapore. And with new supply moderating sharply and landlords actually doubling down on upgrading all these older assets, Singapore industrial and logistic market is well positioned for further rental growth and capital appreciation. And moving forward, REITs that is exposed to these modern logistic and high-spec industrial assets, such as CapitaLand Ascendas Trust and Mapletree Industrial Trust, these structural tailwinds actually provide a robust underpinning for earnings resilience heading into this year. And next, for Singapore prime CBD office market. Despite global headlines of office weakness, we are actually seeing a clear flight to quality in Singapore. Tenants aren't leaving. They are consolidating into premium grade A buildings. And core CBD vacancy has actually tightened to around 5.1% with no meaningful new supply until 2028. And this actually positions landlords like CapitaLand Integrated Commercial Trust, who has a strong sponsor, strong balance sheet, and prime assets such as Capital Spring, Capital Green, and 6 Battery Road and Raffles City to actually benefit in an increasingly landlord favorable market. And turning to retail, performance has been more split. We actually favor suburban and heartland malls within the retail space, which have proven to be more resilient due to their focus on essential, non-discretionary spending. So in this space, Fraser Centrepoint Trust FCT actually stands out as a defensive player, offering stability and visibility in cash flows. Though some investors may have concerns about the RTS link taking away much of Causeway Point foot traffic or business, we don't think it's too much of a concern. So firstly, the RTS link has limited capacity. They have a peak capacity of 10,000 passengers per hour per direction. And assuming that they operate 6 a.m. to 12 midnight, that's about 18 hours. This translates to roughly 180,000 passengers per day. And this is only half of the 350,000 daily land crossing between Johor Bahru and Singapore, meaning it can only serve a fraction of the total cross-border traffic. And the 4 km journey actually takes about 5 minutes, and the customs and immigration at the departure station actually adds about 10 to 15 minutes. So the total travel time is around 15 to 20 minutes. While convenient, this is not a dramatic time saving for most travelers, particularly those making bulk trips or carrying heavy goods. And therefore, the majority of shoppers are likely to continue visiting local heartland malls, limiting any material impact on footfall. And secondly, there's also cross-border accessibility may also encourage F&B operators and service tenants near the border to be more competitive. This actually helps to improve offerings in terms of pricing, menu variety, or even quality. And for malls like like Causeway Point, this can actually benefit overall mall performance as underperforming tenants that fail to meet the evolving consumer preferences may naturally exit, leaving space for higher demand tenants. And this actually aligns with the long-term mall dynamics where healthy churn improves tenant mix and enhance the shopper experience. And while discretionary spending such as dining, personal care, leisure may shift slightly, essential goods like groceries and daily necessity will actually remain local due to the inconvenience of carrying all these bulk items across the borders. So as such, supermarkets, wet markets, and F&B staples in heartlands are expected to retain a loyal customer base. And the industry most likely to experience minor competition from JB are service-related sectors such as your dental services or your hair, nail salons, and massage services where consumer may be more price or variety sensitive. And even here, any effect is gradual, giving landlords and tenants time to adjust offerings to meet demand. And overall, in terms of risk, the RTS link may actually enhance selective competition, but it's unlikely to materially threaten the core business of heartland malls. And hence, we actually continue to show our preference for suburban retail. And as you may have guessed, based on our preference, we remain cautious on discretionary retail, such as luxury malls along Orchard Road and hospitality. So why, you may ask? Firstly, wage pressures may constrain luxury spending. And secondly, a strong Singapore dollar actually reduces tourist purchasing power. And based on recent tourism data, tourists are actually shifting away from retail towards and spending more towards experiences like entertainment. And in short, these sectors are more volatile and sensitive to global sentiment, making them less attractive in the near term. And overall, valuations remain reasonable even after last year's rebound, as REIT trade at 0.99 times price to book, broadly in line with the 10-year average. And for income-focused investors, the yield spread versus the 10-year government bonds has actually widened to 3.2%, up from 2.7% 3 years ago, restoring the sector's appeal for yield-seeking investors. And adding to the case is a structural catalyst, the Singapore Next 50 Index. So S-REIT actually make up 16 of these 50 names within this new index, representing roughly 46% of the index market capitalization. So why does this matter? New ETFs tracking the index could actually drive passive inflows into this mid-cap S-REIT, narrowing the valuation gaps and increasing visibility for names that typically lack the large cap liquidity. So what should investors consider? CapitaLand Integrated Commercial Trust, if you are looking for high quality prime commercial exposure, or Fraser Centrepoint Trust, which is a defensive suburban retail play within the retail space. Or even if you're looking for growth engines, we recommend CapitaLand Ascenders REIT and Mapletree Industrial Trust, given their focus in high-spec industrial and data center assets. And each of these actually combines balance sheet strength with structural sector tailwinds, providing both stability and growth. And for investors preferring diversification over stock selection, the Lion Philippe S-REIT ETF is actually a strong alternative. It tracks high quality, high yielding REITs with disciplined financial screens. We also have a target price of it of 0.93 Singapore dollar, which is about 5% upside, along with a projected annual dividend yield of 5.6%. And we believe that this is a balanced way to participate in the sector's recovery without concentrating on single names. And to conclude, the S-REIT outlook for this year is actually increasingly constructive. And the sector actually benefits from easing interest rate, which help to support the cash flows, and resilient rental fundamentals, like what we have seen in the earlier slides, and also revival in capital market activity because of the easing rate is giving REITs manager more confidence in embarking certain projects and capital recycling activity, choosing to divest certain non-core assets and looking to invest in higher margins or higher yielding assets. And however, recovery will not be uniform across the S-REITs. Subsector performance and balance sheet strength are key differentiators. A selective approach focusing on high quality suburban retail, prime commercial and industrial assets offers the most attractive risk reward profile. Thank you for joining us this evening. I hope this was insightful and actionable, and I'll be happy to take any questions you may have. Thank you.
Thank you, Charmaine, for the sharing. We are now opening the floor to questions. So feel free to type your questions that you have for any of our presenters in the Q&A box. We'll give a few minutes while we wait for the question to filter in. And yep.
Okay. Yeah, let's give Charmaine a break first while I take some questions. I see there are some questions on maps already. But first thing is I would like to let everyone know that we actually have a new email address for our maps portfolios. It's called askmaps@fundsupermart.com. So if you have any questions regarding the portfolios, about the fee structure, the positioning, you can just send your questions to that email, and my team and I will get back to you. Yeah, I've put the email on the share screen already. So yeah, you can note it down. Okay, let's get to the questions. Yeah, I see a question on why is the performance for the MAPS portfolios different for the different risk appetites? The reason for that is, okay, so first of all, for MAPS, we have five different risk profiles, conservative to aggressive. So the conservative portfolio is made up of 10% fixed income, 90% equities. Moderately conservative is 30% fixed income, 70% equities, so on and so forth. So generally, equities, they tend to outperform fixed income most of the time. There are only certain years where fixed income managed to do better than equities. So which is why you see our aggressive portfolios, they tend to perform better compared to the conservative portfolios. So depending on your risk appetite as an investor, if you're a younger investor, you have a longer investment horizon, greater risk appetite, then you can consider perhaps one of the more aggressive portfolios. But on the other hand, if you are a more conservative investor, you just want somewhere safe to park your cash, hopefully earn some modest returns that beat inflation, then you can consider one of the more conservative portfolios. Right, there's also a question on the annual fee for MAPS. Okay, so for the fees, there's two different fees. For the conservative portfolio only, the fees are 0.0875% per quarter. Okay, so at FSM1, we charge fees on a quarterly basis. So that works out to be about 0.35% per annum. And for the rest of the four portfolios, from moderately conservative all the way to the aggressive portfolios, the fees are 0.125% per quarter, or roughly 0.5% per annum. Okay, I see a follow-up question on MAPS. So do you mean that all MAPS portfolios contain the same holdings but in different proportions? Yes, the answer is yes. So like I mentioned in my sharing earlier, how we actually decide which products to include inside our MAPS portfolios, it really comes from our ETF focus list and our recommended funds list. I'm sure if you've been a long-time investor with FSM1, you'll know that these are two focus lists that we publish on an annual basis. So basically, they contain our best ideas that have been curated by our research team. And yeah, so generally, we tend to pick from these ideas and we put them into the MAPS portfolios. Okay, I see a question on did FSM Maps move into cash during the steep drawdown in 2021 slash 2022? So unfortunately, this is quite a difficult question for me to answer because I was not the portfolio manager back then. But that being said, let me go back and look through the archives and see what the asset allocation strategy was at that point in time, and perhaps I can get back to you via email. So if you don't mind, you can drop an email to askmaps@fundsupermart.com and we'll answer your questions there. Okay, we have a question from William. So how do you balance investment with MAPS and any other individual ETFs? So, okay, so coming from the perspective of a novice investor, I think how I would approach this is you can use MAPS as a core portfolio. Because if you look at the products inside our MAPS portfolios, you look at the asset allocation, they are generally very diversified across different geographies and also across different products, which includes your ETFs and your unit trusts. So you can treat MAPs as your core portfolios. Then, for instance, if you have ideas on, let's say you want to invest in gold, or you would like exposure to tactical ideas like robotics or AI, then I think you can include a smaller percentage of your total investment holdings into these individual ETFs. But our recommendation here is that you perhaps try to cap your these tactical allocations to around 10%, so as to ensure that your entire investment portfolio does not become overly aggressive. Yeah, so that's how I would approach investing, balancing a MAPS investment with other individual ideas that you may have.
Hi, there's a lot of questions. Maybe I just share the slide on the ETF first. Someone requested for this slide on the ETF. Yeah, is this the slide you're looking for? Yeah, okay, I'll go question by question. Okay, so I saw there's one about any reason why Mapletree Industrial Trust is down so much the past year. Is it only due to US data center exposure, or are there other reasons? So Mapletree Industrial Trust shares have actually declined due to a combination of lower quarter two financial year 2025-2026 net property income, which actually fell 7.8% year on year, and a 5.6% drop in DPU. And this dip is actually driven by portfolio divestment in Singapore. So this and also reduced income from North American assets due to lease non-renewals, and also the weaker USD against the SGD exchange rates. So all this actually poses concern as investors worry about maybe the distribution and the outlook, and how can Mapletree Industrial Trust actually move forward from here, like whether through the capital recycling can they actually recover. So there's a lot of uncertainty which actually caused that drop. And we believe that despite this decline, the trust actually reported a resilient 91.3% portfolio occupancy for that quarter, and is actually pursuing a strategy to divest up to 600 million SGD in assets to actually rebalance the portfolio with a focus on data centers and high-tech buildings. And yeah, so I hope that answers in terms of that. So it's undergoing a transformation stage whereby they are actually going undergoing some form of capital recycling. And also another question on Mapletree Industrial Trust is facing some challenges in its US data centers. Can you comment? So the rapid expansion of AI is actually driving a surge in US data center development, with investment projected to top 2 trillion over the next 4 years. However, this boom has actually created a critical cluster of risk, resulting in 64 billion in projects being delayed or blocked due to local oppositions and resource constraints. And key issues can be like maybe because all these data centers are eating up a lot of energy, and it's not the most if it's not ESG friendly, it might pose some issues against some opposition groups. And so firstly, severe power grid strain and shortages. So data center powers are expected to increase 133% by 2030. And this will actually consume 426 trillion watts of electricity. This is creating a power crunch whereby by 2028, up to 19 gigawatts of demand may actually go unmet, according to S&P Global Energy. And also interconnection delays. So the average time for new power projects to connect to the grid actually exceeds 8 years, delaying data center operations. And also another issue is also phantom projects. So a high number of speculative projects are clogging the queue, making it hard for the utilities to actually gauge the actual demand. And another thing is also the grid stability. So data center demand is actually straining local grids, prompting states like Texas to actually consider kill switch mechanism to disconnect data centers during emergency. And also another thing that I hinted just now is also the high environmental impact, like water and carbon. So there's massive water consumption because data centers often use evaporative cooling, consuming millions of gallons of water daily, which actually causes strain on local resources in drought-prone areas like Arizona and Texas. And also the AI boom is actually derailing sustainability goals. Google's emissions actually rose 51% due to AI energy demands. And also on-site diesel generators for used for backup are frequently running for demand response to support the grid, actually causing further air quality issues. So this actually kickstart a lot of opposition and political backlash as well. And lead time for large electric transformers have actually increased to 3 or 4 times longer than in 2020 because of this demand. So increasingly, we are seeing a lot of innovation in looking at how can they reduce the water consumption to actually cool down all these data centers, or even how they can look to consume less energy and maximize output. So to mitigate this risk, some firms are actually turning to alternative cooling methods and investing heavily in renewable energy. Though these solutions actually often compound power demand in the short term. So that's uh, the the flavor of what's happening in US data centers. And I also saw another question on what is your take on CLR versus CFA. So for investors actually seeking diversified exposure to S-REITs, ETFs can be considered, which is what you referably highlight, CLR or CFA. So CLR is the Lion Philippe S-REIT ETF, and this actually tracks the Morningstar Singapore REIT Yield Focus Index with its highest exposure to industrial S-REIT and also some exposure in data centers.
Okay, maybe I
Which are
can.
like sectors that Holdings, Street, and Mapletree Industrial Trust are well positioned for long-term growth. And also, secondly, another ETF that you point out, which is CFA, Nikko AM Straits Trading Asia X Japan REIT ETF, actually offers broader regional exposure by tracking the FTSE Empire REIT Asia X Japan Index. So you can see it as if you want just purely Singapore S REIT, then CLR will be for you. But if you want like beyond just Singapore S REIT, you want some other REITs that's in the region like Asia X Japan, then CFA may be better for you. But we do see that for the CFA, it also maintains a strong 70% allocation to S-REIT, which share similar top holdings with CLR, and its second largest sector weight is also in industrial S-REIT and some exposure in data centers as well. Yeah.
Okay, maybe we can jump to some MAPS questions. Okay, let me see. There's a question on, do we take into consideration regional conflicts in determining a strategy for MAPS? So I think the way to think about this is whether or not such conflicts will actually have a structural implication. So like I said, our MAPS portfolios are created for long-term investors. At FSM1, we are all long-term fundamental investors. So it really depends on whether or not these things will affect whichever market. So for instance, if the US, let's say, across 2025, there has been a lot of geopolitical tension, starting with the Liberation Day terrorists back in April, followed by the US bombing a few of Iran's nuclear facilities. So those events have created near-term shocks, but as you can see from where markets are today, I think most investors, they have actually forgotten about them already. So in other words, these are not material in terms of how it affects our fundamental investment thesis. And I think this is usually the case for most geopolitical events. I'm not saying all geopolitical events are like that, but I think for most of the time, things like these, they don't really change the underlying investment thesis. So what we really look for is earnings. Earnings is something that we look at very closely, as well as valuations. Because in order to make money, you have to buy investments at a sensible price. And for earnings, they, in the long term, share prices are ultimately driven by earnings, which is why we pay very close attention to earnings. We make sure that the companies that we buy, the sectors that we invest in, they are structurally sound, they have a fundamental growth story to them, and the companies within that sector can deliver earnings growth over the next 3, 5, maybe even 7, 10 years. and that should drive share prices higher. And I think case in point would be our allocation to the digital economy. So like semiconductors, for instance, I think it has gone up more than 100% since a couple of years back already. And I think since we introduced it into our portfolios as a tactical allocation, I think it was probably pre-COVID. I think it has done extremely well, probably the best performing fund inside our portfolio already. Okay, there's a question on, can MAPS also go short equities and does it use derivatives like options? Okay, so the short answer is we don't go short and we also don't use derivatives. So all our investments are long investments and they mainly consist of unit trusts and ETFs. So there are no single stocks inside.
Okay, maybe I take some more question. I also saw someone ask about, for Singapore commercial, what's your view of Keppel REIT relative to CICT, which has about half in retail? So, firstly, let me address in terms of balance sheet health, looking at its interest coverage ratio and leverage, we are not as comfortable with respect to CICT. And also on the retail aspect, actually 40% for CICT comes from office, while 25% comes from integrated development, which are actually well located in or near office districts. So in a way, if we factor that in, about 65% is actually more towards targeting more towards office. So that's why like we still classify CICT as more of a commercial exposure because they are targeting more towards foot traffic within the CBD space. And in fact, looking at in terms of rental reversion for the latest quarter that they reported, third quarter last year, Keppel, we do prefer CICT and with relative to Keppel REIT and Suntec REIT because of their balance sheet health. So once again, looking at the interest coverage ratio as well as the leverage ratio as well. Yep. And also I saw another quite important question on gold. So at iFAST, like what Terji mentioned, we are fundamental investors. So we invest in things that we have a long-term view on and are built on fundamentals. So what we mean by that is we invest in companies or equities that actually have earnings. So we believe that what drives share prices are the company's earnings. So in short, EPS drive the share price of a company. So so for gold, because it's not a productive asset, we generally do not recommend investors to actually buy gold. So maybe just to provide some context, so recently we actually saw a sharp reversal in fortunes, like it crashed on after Friday night. And this is after reaching a record high near USD 5.6K. The metal actually retreated below USD 5K, plunging more than 12% in a single day, which is its largest one-day drop since the early 1980s. And while some investors may interpret this pullback as a buying opportunity, we actually believe the scale and speed of the sell-off actually reinforce our cautious stance on gold. So we believe that drop was also because the new Fed chair has been nominated on that day as well, which actually is the earlier fears of the Fed actually losing its independence. And this reassurance was actually echoed in fixed income markets where US Treasury yields and rate futures actually remain largely stable. And the muted market response actually suggests that continued confidence in the Fed's independence and resilience of the US financial system. And another issue that we also saw that might have caused the drop was also that US government may no longer back prices for critical minerals project. So this also signal less direct intervention in commodity markets. So as a whole, together these developments actually reduce the need for investors to actually seek protection in gold, which actually set the stage for the sharp correction that follow. And also there's also the argument about debasement trades and the de-dollarization. But for us, we think that that's more short-term. So a central pillar of the long-term bullish case for gold is the expectation of a structurally weaker USD over an extended horizon. And we disagree with this. So despite persistent narrative around this, the fundamental drivers of USD strength actually remain intact. We still think that the USD is like the global reserve currency, and also global capital continues to flow into US asset, and particularly all the tech companies. And this sustained demand actually provide a structural tailwind for the currency as well. Even though overall we still have we still expect a moderate depreciation in the USD, but over the longer term, like 5 years, 10 years, we do think that issues such as the debasement of it and maybe USD no longer being the global currency, we think that's not something that can happen like over the next 1 year, because the USD actually remains deeply entrenched in global trade settlement and reserve holdings and transaction system. And displacing such a powerful network effect is actually a multi-decade process, not a cyclical shift. And as long as the USD actually remains the backbone of global trade, the weak dollar thesis actually underpinning the gold bullish case actually remains more fragile. And stripping away that gold is actually more sentiment driven and not fundamentally anchored, like what I hinted just now about how its valuation is heavily driven by sentiment and macro narrative and headlines such as fear, inflation anxiety, or geopolitical stress rather than underlying economic cash flows. So this actually make gold difficult to value and also susceptible to the boom and bust cycle. And the recent sell-off is also a reminder that the gold safe haven status is often more psychological and than structural. So in short, for gold, we do think of it as a portfolio diversifier. So if because we recognize some of the diversification benefits that gold can provide. But with that being said, we do see that the correlation of gold with some of the, like for example, some of the other asset classes like MSCI US, US Treasuries, or even US corporate bonds, the correlation have actually increased. So for diversification benefits to be like better, the asset classes shouldn't have a very high correlation. So with some rising of correlation, though it's still at a low level, we do think that the role of a diversification benefit of gold is not as good as back then, like in 1970s. And as such, we do not advocate buying the dip in gold for capital appreciation. And instead, gold should be viewed as a portfolio diversifier. And for investors seeking diversification, a modest gold allocation of 0% to 10% can be appropriate. And instruments such as the ETF GLDM actually provides an efficient way to implement this exposure. Yeah, that's all.
Shami, I think we can take one last question.
Okay.
There's this
Actually-
particular question is quite cute. Is any comments on the Mapletree, Pan Asia Commercial Trust, Hong Kong assets, and any positive reversion soon?
So I think for Mapletree Pan Asia Commercial Trust for the third quarter last year results, they did mention that because of the assets in the area, like in Hong Kong and China, like they actually dragged down the overall rental reversions, even though if they excluded those portfolio, VivoCity actually remained the strong one. And if they exclude the China and Hong Kong exposure, rental reversion for Mapletree Pan Asia Commercial Trust, VivoCity actually drove most of the rental reversion. So that was the point of why I highlighted that there's one of the key pillars supporting S-REIT outlook is the Singapore Shield. So we do see that across the board, S-REIT with larger exposure to Singapore assets actually perform better, or at least they show greater resilience and better, healthier rental reversions. And a lot of the S-REIT that we see that reported their rental reversion, they do cite that this portfolio in this country not doing well, and that in that country not doing well, and most of it we see is in other markets and not really in Singapore. And hence for Mapletree Pan Asia Commercial Trust, I will say that if anything, the what is supporting its earnings and positive outlook will be more of the Singapore assets component, which in this case VivoCity, especially with the Circle Line becoming a full circle soon, connecting both Marina Bay and Harbourfront. It will be a lot easier for tourists to travel between these two very tourist heavy attraction location easily, because if you look at the public transport map right now, if a tourist want to move from Marina Bay to Harbourfront to go to USS or see Oceanarium, they would have to take public bus. They can't really take a MRT to like directly connect that circle line. So with the new circle line becoming a full circle connecting these two stations, we do see increasing foot traffic for Mapletree Peninsula Commercial Trust. But it's still too early to actually comment anything about the Hong Kong and China exposure for Mapletree Peninsula Commercial Trust in this aspect. So yeah, I hope that helps.
Sorry, Ikai, before you end, I'll just take last few questions on MAPS. I'll be quick, I promise.
No worries,
Yeah.
no worries. Yeah.
Okay, so first one, there's a question on the PIMCO Income Fund that is heavily weighted towards agencies like Fannie Mae. So I think, first of all, I think PIMCO Income Fund, yes, it is our recommended fund. One thing to note is also it has a investment grade quality AA minus. So I think that also tells you that it is relatively safer compared to other funds which may have a lower credit rating. And on top of that, I think Fannie Mae, it is also a government-sponsored enterprise. If I'm not wrong, they were built out by the government during the 2008, the crash in 2008. So I think with that implicit government backing, I am not extremely worried about the risks about PIMCO Income Fund being overly exposed to Fannie Mae. And I think being exposed to such ABS is also where they get the yield from. Okay, so another question is, I think this is a follow-up from earlier. Do we have the discretion to move the portfolio into cash? So the short answer is yes, but within certain limits. So right now, our cash allocation, or what we classify as short duration bonds, cash short duration bonds, it has a neutral allocation of 30%. So which also means that we can, 30% being relatively large compared to the rest of the fixed income segments, we can afford to overweight or underweight this segment by 15%. And just to share, when rates were high, probably around 1 year, 1.5 years ago, we actually raised our short duration exposure or cash exposure to as high as 37.5% to take advantage of the higher yields. So yeah, short answer, yes, but within certain limits. And that also applies to all the different asset allocation sleeves that we have inside MAPS. Yeah, I think that should be it already. Handing the time over to you, Ikai.
All right, thank you very much. So, and that's the last question that we'll take for tonight. So thank you once again, Tajin and Charmaine, for the wonderful sharing tonight. So I'm sure we all have learned a thing or two, and quite a lot of questions on maps and REITs. And thank you everyone for your enthusiastic participation. And also a big thank you to everyone here again who is here with us this evening. So I hope you find the sharing useful in your investment journey for 2026 and beyond. So before I end, I just want to do a quick shout out to the current promotion that we are running. So just give me a moment. So right now we are running a promotion on selected funds and ETF. So if you are aware, we have just ended our FSN Invest Expo on 17 January. For those who attended, thank you very much for being there with us. So we have a post Invest Expo event promotion that we are running right now, and that is you can see on the screen. So for selected funds, for any investments for minimum, at least a minimum of 10K investment, you'll get some cash back. And then if you prefer to trade in ETFs, for selected ETF, there will be three processing trade. This promotion is valid from now till all the way till the end of February. So do take this opportunity to invest in your favorite funds, or if you want to do ETF trading. Another thing that I would like to, highlight and shout out again is connect with us. Just want to shout out our social channels that we are on. Connect with us. So these are on the screen, you can see all the various social channels that we are on actively. I would actually like to highlight our Telegram channel because for our Telegram channels, we do have daily updates on interesting, relevant news. Our Daily Brew is on every morning to share the updates about what's happening, be it in the US market or the Asian market the previous day before. And we also occasionally have updates about new important articles. In fact, Charmaine actually just published an article on gold recently, So if you were to look back at our Telegram channel, you can find the article and then you can see our take on it. And then, but if you prefer to connect with us on other channels, we have Instagram, we have Facebook, and we have YouTube. And of course, our website, whereby you can find out information that you need for your investment journey. I'm just going to leave this screen on for a while, but I just want to say thank you. And with that, the webinar has ended, and have a great evening, everybody. So feel free to leave the room, and while we leave the screen up here for a while. Thank you again, once again.